sign. I always make a sign. So my name is May Doldelau. Good morning, good morning. This is May. And my Instagram account, which you're on, if you're on Instagram, is May Doldelau. And if you're on YouTube, this is Creative Abundance Now. And I'm so excited to be here today to do this live with you. So we're going to do chapter 11 of The Intelligent Investor by Benjamin Graham. And that is security analysis for the lay investor, right? Before I start, I want you to know my blog is yesfinanciallyfree.com. Go there, put in your first name and your email address on the right side. You'll get on my email list. And I just emailed my list, told them I'd be live. Start at 8:30, but I'm a little late this morning. But I am here. I emailed them and told them. Some mornings I haven't been on. I'm doing the reading of one chapter of this book every day, every weekday at 8:30 a.m. Hawaii time, which is 12:30 p.m. Eastern time. However, some days it's hard for me to wake up early because now I am also in charge of my son's homeschool. He's in kindergarten. And I noticed that I need a lot more energy to stay awake and be active with my son all day. But today I'm here, so we're excited because we're going to get it done today. So chapter 11 of The Intelligent Investor by Benjamin Graham. Now a little bit about myself. I have a business. My first business, yesfinanciallyfree.com is my blog, where I talk a lot about financial freedom, everything there, my story. But just so you understand who I am and what my story is, I live in Hawaii with my husband and my son, Jordan. He's 6 years old. When I started this blog, my son wasn't even born yet, okay? And I had a lot of financial difficulties. Back in 2011, I had over $40,000 of credit card debts, personal line of credit debts. There were like 8 different debts I owed that totaled over $40,000. And I only had a salary of like $35,000, worked at a local bank here in Hawaii. And that was before taxes were taken out, okay? So it took me a while, but by 2016, I had paid off all that debt, was making almost $500 a month in passive income for our family, had improved our family's net worth by $500,000. We bought our first property in 2017, as well as went on a month of vacation. We went to Niagara Falls, Toronto, LA, Washington, D.C., Buffalo, Mexico, went on a cruise. I'd never gone on a cruise before. It was on my one of my dreams, and I went on a cruise. 2018, we bought our second property, which is an Airbnb business. And we actually then took our first property, converted that into a second Airbnb business, which we sold to our manager. And we bought this property, which is a 2-bedroom condo, bigger than the other one, which is a 1-bedroom, and nice view. And if you're on Instagram, you saw the view. And we're like 2 blocks from the beach, Waikiki Beach, and it's great. We have a locker where we put our surfboards. It's just really nice. I've been to the ocean. Last 5 days, I've been to the ocean every day with my son. My husband, too, he's gone. Last 3 days, we've all been going. It's been really fun. So we live in a really nice place. And I know right now COVID-19 is causing a lot of chaos. With our Airbnb too, tourism is basically shut down in Hawaii almost. So we don't really have, we're lucky we have someone in there. They moved to Hawaii, so they booked us for a month. But we have to book now for a month at a time. Visitors need to quarantine for 14 days. So if you're struggling with COVID and all that, I understand how that is. But I'm really glad I live in Hawaii. Because it's just such a nice place to be. If you can't go travel anywhere, if you're here, it's already nice to be here, which is why I live here in the first place. And I tell you that story because I want you to understand that if you're not good with money, all right, and if you don't have any special education with money, you can become good with money, all right? Anyone can do it if they just choose and decide, I want to be good with money. You can do it, all right? You don't have to have a fancy job. You don't have to have a big cash flow, all right? You can have a lot of debt. You can still improve your net worth. You can improve your passive income. You can create more free time for yourself. And you can restructure your lifestyle so that you have more time to go to the beach or whatever you want to do. In Hawaii, we can go to the beach, but we cannot stay on the beach. We can walk on it, jog on it, run on it, walk across it to get in the ocean, but we can't hang out while the whole COVID thing's going on. So So that's my story. And I'm reading this book because Warren Buffett recommended it. And Warren Buffett is really smart at investing. And my whole philosophy with my blog and everything, I have a lot of book reviews on my blog, a lot of knowledge I've gotten from books and teachers. And my philosophy is if they are that good with money, go learn from them, do what they say to do, and see the results. And you can see the results in my life. Like, I do what they tell me to do, right? I pay myself first, right? Every time I get money, I put aside money first to invest for making us more money, right? That's how we get our passive income money. And I've been doing that for years now, and it's a habit, yeah? And so I learned that from all these places, and I keep doing it, and I keep doing what they say, and that's what has improved our life. And you can tell, and the nice thing about money is you can just measure it, right? It's really easy. You can have feelings about how you're doing, but you just have to measure it. It's the same with kind of your health, just do your blood work, do your weight, do your measurements. You can tell how you're doing, and the same thing with money. How much money do you have? How much do you owe? Right? How many assets do you have? How much passive income do you make? You can calculate it. And we do that every month. And I have a business called Finance Freedom Mastermind. So, I forgot to mention, I quit my job in 2016. Started Finance Freedom Mastermind program where I mentor people on how to become financially free as quickly as possible. And in that program, we track our numbers every month. And the reason we do that is we want them to improve. And what numbers do we track? We don't write and track debt because we don't want our debt to increase. Okay, so we don't track it. Whatever you track and put your attention on, it will increase and expand. So what we track is our net worth number, which is another way of saying our balance sheet. We track our balance sheet. What is our net worth? How much are we really worth? Rich people, they talk about their net worth. So if your net worth is going up and up and up, you're doing something right. You're getting richer and richer and richer. If your net worth is not improving, then there's something that needs to be done, right? It's that simple. Passive income. If your passive income isn't growing, then there's something there blocking the growth, and then you work on it. It's really that simple. So I highly encourage you, if you want to create financial freedom, if you want passive income, if you want your net worth to increase, you want to become a richer person, if you want your free time to increase, if you want to have a better lifestyle, then I highly encourage you to go to yesfinanciallyfree.com. Check out the products on the products page, yeah? All of my Finance Freedom Mastermind products and programs are there. They range from $7 to $5,000, depending on how much hand-holding and coaching and personal attention you want. Now, yesfinanciallyfree.com, if you get on the email list, if you put your first name and email in there, you get a free ebook, Working Parents Guide to Financial Freedom. So if you haven't done it yet, just put your first name and email address in and get the ebook. That's free. Plus, the blog has so much information. I've been blogging for years and years and years. If you want to know about books, when I'm done reading this book, actually, there's a blog post where I put every video I've done on these chapters all in one place. So if you just go there, you can see chapter 1, chapter 2, all the chapters. When I'm done reading, I'm going to put a summary video on that page. But that's where it is. So I just want you guys to know that if you're interested in financial freedom and you want a place where you can get real information from a real person, like a parent, right? I'm a working parent. Now I'm a homeschool teacher. So I'm teaching my son kindergarten. So, I've got a lot to do, but I can do it. So if I can do it, you can do it. All right. So let's begin. So today we're reading Chapter 11, Security Analysis for the Lay Investor, General Approach. Financial analysis is now a well-established and flourishing profession or semi-profession. The various societies of analysts that make up the National Federation of Financial Analysts have over 13,000 members. He's writing this book around 1972, just so you guys understand the time frame. Okay. Most of whom make their living out of this branch of mental activity. Financial analysts have textbooks, a code of ethics, and a quarterly journal. They also have their share of unresolved problems. In recent years, there has been a tendency to replace the general concept of security analysis by that of financial analysis. The latter phrase has a broader implication and is better suited to describe the work of most senior analysts in Wall Street. It would be useful to think of security analysis as limiting itself pretty much to the examination and evaluation of stocks and bonds, whereas financial analysis would comprise that work plus the determination of investment policy or portfolio selection, plus a substantial amount of general economic analysis. And he has a footnote. Our textbook, Security Analysis by Benjamin Graham, David L. Dawes, Sidney Caudle, and Charles Tatham, 4th edition, 1962, retains the title originally chosen in 1934, but it covers much of the scope of financial analysis. I have that book there. I'm going to read that next. It's very big. Okay, moving on. In this chapter, we shall use whatever designation is most applicable, with chief emphasis on the work of the security analyst proper. The security analyst deals with the past, the present, and the future of any given security issue. He describes the business, he summarizes operating results and financial position, he sets forth its strong and weak points, its possibilities and risks, he estimates its future earning power under various assumptions or as a best guess. He makes elaborate comparisons of various companies or of the same company at various times. Finally, he expresses an opinion as to the safety of the issue, if it is a bond or investment grade. Don't know why I had a beep on my computer, but if it is a bond or investment grade preferred stock, or as to its attractiveness as a purchase, if it is a common stock. In doing all these things, the security analyst avails himself of a number of techniques ranging from the elementary to the most abstruse. He may modify substantially the figures in the company's annual statements, even though they bear the sacred imprimatur of the certified public accountant. He is on the lookout particularly for items in these reports that may mean a good deal more or less than they say. The security analyst develops and applies standards of safety by which we can conclude whether a given bond or preferred stock may be termed sound enough to justify purchase for investment. These standards relate primarily to past average earnings, but they are concerned also with capital structure, working capital, asset values, and other matters. In dealing with common stocks, the security analyst, until recently, has only rarely applied standards of value as well defined as were his standards of safety for bonds and preferred stocks. Most of the time, he contented himself with a summary of past performances, a more or less general forecast of the future, with particular emphasis on the next 12 months, and a rather arbitrary conclusion. The latter was and still is often drawn with one eye on the stock ticker or the market charts. In the past few years, however, much attention has been given by practicing analysts to the problem of valuing growth stocks. Most of these have sold at such high prices in relation to past and current earnings that those recommending them have felt a special obligation to justify their purchase by fairly definite projections of expected earnings running fairly far into the future. Certain mathematical techniques of a rather sophisticated sort have perforce been invoked to support valuations arrived at. We shall deal with these techniques in foreshortened form a little later. However, we must point out a troublesome paradox here, which is that the mathematical valuations have become most prevalent precisely in those areas where one might consider them least reliable. For the more dependent the valuation becomes on anticipations of the future, and the less it is tied to a figure demonstrated by past performance, the more vulnerable it becomes to possible miscalculations and serious error. A large part of the value found for a high multiplier growth stock is derived from future projections which differ markedly from past performance, except perhaps in the growth rate itself. Thus, it may be said that security analysts today find themselves compelled to become most mathematical and scientific in the very situations which lend themselves least auspiciously to exact treatment. Basically, he's saying they're just guessing and they're using math to justify their guesses. Let us proceed, nonetheless, with our discussion of the more important elements and techniques of security analysis. The present highly condensed treatment is directed to the needs of the non-professional investor, which is most people. At the minimum, he should understand what the security analyst is talking about and driving at. Beyond that, he should be equipped, if possible, to distinguish between superficial and sound analysis. Security analysis for the lay investor is thought of as beginning with the interpretation of a company's annual financial report. This is a subject which we have covered for laymen in a separate book entitled The Interpretation of Financial Statements, with Charles McCorlick, Harper and Row, 1964. That's probably a good book. We do not consider it necessary or appropriate to traverse the same ground in this chapter, especially since the emphasis in the present book is on principles and attitudes rather than on information and description. Let us pass on to two basic questions underlying the selection of investments. What are the primary tests of safety of a corporate bond or preferred stock? What are the chief factors entering into the valuation of a common stock? Bond analysis. The most dependable and hence the most respectable branch of security analysis concerns itself with the safety or quality of bond issues and investment-grade preferred stocks. The chief criterion used for corporate bonds is the number of times that total interest charges have been covered by available earnings for some years in the past. In the case of preferred stocks, it is the number of times that bond interest and preferred dividends combined have been covered. The exact standards applied will vary with different authorities. Since the tests are at bottom arbitrary, there is no way to determine precisely the most suitable criteria. In the 1961 revision of our textbook, Security Analysis, we recommend certain coverage standards which appear in Table 11.1. Our basic test is applied only to the average results for a period of years. Other authorities require also that a minimum coverage be shown for every year considered. We approve a poorest year test as an alternative to the 7-year average test would be sufficient if the bond or preferred stock met either of these criteria. I don't know what I just read, so I'm going to go back and look at it real quick. The most dependable has the most recycled branch of security analysis concerns itself with the security or quality of bond issues. Okay. Chief criterion or preferred stock. Used for corporate bonds is the number of times that internal interest has been covered by available earnings for some years in the past. In the case of preferred stocks, the number of times the bond interest and preferred dividends combined have been covered. Okay, so basically saying we can tell if they're good because they're paying what they said they'll pay. If they're still paying, then that's a good sign that they're a good bond or a good preferred stock. The exact standards applied will vary with different authorities. Since the tests are at bottom arbitrary, there is no way to determine precisely the most suitable criteria. Okay. All right, so he has a table here. There's a table for YouTube people, Table 11.1, and then here's the table for Instagram. Recommended minimum coverage for the bond and preferred share stocks. Okay. There's a lot of stuff written on it. So, in the table, he has recommended minimum coverage for bonds and preferred stocks. And he has for investment grade bonds, the minimum ratio of earnings to total fixed charges. And he says that for a public utility operating company, they have 4 times the minimum ratio of earnings to total fixed charges. So they earn 4 times as much as their fixed charges. And that's average of the past 7 years. The poorest year was 3 times. Average of the past 7 years was 2.65 times. How can they, okay. Before income taxes, it's 4 times average of the past 7 years, and 3 times was the poorest year. But after income taxes is 2.65 times is the average over 7 years, and 2.1 is the worst year. For the railroad, they have 5 times is the average over the past 7 years. The poorest year was 4 times. That's before taxes. After taxes, it was 3.2 was the average earnings over the fixed charges. And then the worst year was 2.65. Industrial was 7. So they make 7 times more than their fixed charges. The alternate measure for the poorest year was 5. And then average of past 7 years is 4.3. Alternative measured by poorest year is 3.2. Retail concerns. 5. They earn 5 times as much as their fixed charges. Their poorest year is 4 times as much. Average in the past 7 years is 3.2 times as much, and the alternate in the poorest year is 2.65. And then he has B. For investment-grade preferred stocks, the same minimum figures as above are required to be shown by the ratio of earnings before income taxes to the sum of fixed charges plus twice preferred dividends. The inclusion of twice the preferred dividends allows for the fact that preferred dividends are not income tax deductible, whereas interest charges are so deductible. Other categories of bonds and preferreds. The standard given above are not applicable to public utility holding companies. So he uses a standard for public utility operating company, but not the holding company. Financial companies, real estate companies. Requirements for these special groups are omitted here. Okay. All right, moving on. It may be objected that the large increase in bond interest rates since 1961 would justify some offsetting reduction in the coverage of charges required. Obviously, it would be much harder for an industrial company to show a 7 times coverage of interest charges at 8% than at 4.5%. To meet this changed situation, we now suggest an alternative requirement related to the percent earned on the principal amount of the debt. These figures might be 33% before taxes for an industrial company, 20% for a public utility, and 25% for a railroad. Should be borne in mind here that the rate actually paid by most companies on their total debt is considerably less than the current 8% figure, since they have the benefit of older issues bearing lower coupons. The poorest year requirement could be set at about 2/3 of the 7-year requirement. In addition to the earnings coverage test, a number of others are generally applied. These include the following. Size of enterprise. There is a minimum standard in terms of volume of business for a corporation, varying as between industrials, utilities, and railroads, and a population for a municipality. Number 2, stock equity ratio. Hi, Tom Hagen. Welcome. Where are you from? This is the ratio of the market price of the junior stock issues to the total face amount of the debt, or the debt plus preferred stock. It is a rough measure of the protection or cushion afforded by the presence of a junior investment that must bear the brunt of unfavorable developments. This factor includes the market's appraisal of the future prospects of the enterprise. Okay. So first thing, he's talking about all these different factors, right? Property value, number 3. The asset values as shown on the balance sheet or as appraised were formerly considered the chief security and protection for a bond issue. Experience has shown that in most cases, safety resides in the earning power, and if this is deficient, the assets lose most of their reputed value. Asset values, however, retain importance as a separate test of ample security for bonds and preferred stocks in 3 enterprise groups. Public utilities, because rates may depend largely on the property investment, real estate concerns, and investment companies. At this point, the alert investor should ask, how dependable are tests of safety that are measured by past and present performance? In view of the fact that payment of interest and principal depends upon what the future will bring forth, like COVID-19. Ha ha ha. The answer can be founded only on experience. Investment history shows that bonds and preferred stocks have met stringent tests of safety based on the past, have in the great majority of cases been able to face the vicissitudes of the future successfully. So who is surviving COVID-19 right now? The answer can be founded only on experience. Investment history shows that bonds and preferred stocks that have met stringent tests of safety based on the past have in the great majority of cases been able to face the vicissitudes of the future successfully. This has been strikingly demonstrated in the major field of railroad bonds, a field that has been marked by a calamitous frequency of bankruptcies and serious losses. In nearly every case, the roads that got into trouble had long been overbonded, had shown an inadequate coverage of fixed charges in periods of average prosperity, and would thus have been ruled out by investors who applied strict tests of safety. Conversely, practically every road that has met such tests has escaped financial embarrassment. Our premise was strikingly vindicated by the financial history of the numerous railroads reorganized in the 1940s and in 1950. All of these, with one exception, started their careers with fixed charges reduced to a point where the current coverage of fixed interest requirements was ample, or at least respectable. The exception was the New Haven Railroad, which in its reorganization year of 1947 earned its new charges only about 1.1 times. In consequence, while all the other roads were able to come through rather difficult times with insolvency impaired, the New Haven relapsed into trusteeship for the third time in 1961. In Chapter 17, below, we shall consider some aspects of the bankruptcy of the Penn Central Railroad, which shook the financial community in 1970. An elementary fact in this case was that the coverage of fixed charges did not meet conservative standards as early as 1965. Hence, a prudent bond investor would have avoided or disposed of the bond issues of the system long before its financial collapse. Our observations on the adequacy of the past record to judge future safety apply, and to an even greater degree to the public utilities, which constitute a major area for bond investment. Receivership of a soundly capitalized electric utility company or system is almost impossible, since Securities and Exchange Commission controls was instituted along with the breakup of most of the holding company systems. Public utility financing has been sound and bankruptcies unknown. The financial troubles of electric and gas utilities in the 1930s were traceable almost 100% to financial excesses and mismanagement, which left their imprint clearly on the company's capitalization structures. Simple but stringent tests of safety, therefore, would have warned the investor away from the issues that were later to default. Securities and control was instituted along with the breakup of most of the holding systems. Public utility financing has been sound and bankruptcies unknown. Okay. Among industrial bond issues, the long-term record has been different. Although the industrial group as a whole has shown a better growth of earnings power than either the railroads or the utilities, it has revealed a lesser degree of inherent stability for individual companies and lines of business. Thus, in the past, at least, there have been persuasive reasons for confining the purchase of industrial bonds and preferred stocks to companies that not only are of major size, but also have shown an ability in the past to withstand a serious depression. Few defaults of industrial bonds have occurred since 1950, but this fact is attributable in part to the absence of a major depression during this long period. Since 1966, there have been adverse developments in the financial position of many industrial companies. Considerable difficulties have developed as a result of unwise expansion. On the one hand, this has involved large additions to both bank loans and long-term debt. On the other, it has frequently produced operating losses instead of the expected profits. At the beginning of 1971, it was calculated that in the past 7 years, the interest payments of all non-financial firms had grown from $9.8 billion in 1963 to $26.1 billion in 1970, and that interest payments had taken 29% of the aggregate profits before interest and taxes in 1971, against only 16% in 1963. Footnote 3. These figures are shown in Salomon Brothers, a large New York bond house. Okay. So basically in 1970, the interest payments were 29% of their profits, whereas in 1963 it was only 16%. So they were spending a lot more of their profits on debt. Obviously, the burden on many individual firms had increased much more than this. Overbonded companies have become all too familiar. There is every reason to repeat the caution expressed in our 1965 edition. We are not quite ready to suggest that the investor may count on an indefinite continuance of this favorable situation, and hence relax his standards of bond selection in the industrial or any other group. Common stock analysis. Okay. So basically, the bond stuff is done. You want to make sure that they earn more than their fixed expenses, and he has ratios for different industries. And That basically will protect you for bonds. Okay. Common stock analysis. The ideal form of common stock analysis leads to a valuation of the issue, which can be compared with the current price to determine whether or not the security is an attractive purchase. This valuation, in turn, would ordinarily be found by estimating the average earnings over a period of years in the future and then multiplying that estimate by an appropriate capitalization factor, whatever that means. The now standard procedure for estimating future earnings power starts with average past data for physical volume, prices received, and operating margin. Future sales in dollars are then projected on the basis of assumptions as to the amount of change in volume and price level over the previous base. These estimates, in turn, are grounded first on general economic forecasts of gross national product and then on special calculations applicable to the industry and company in question. An illustration of this method of valuation may be taken from our 1965 edition and brought up to date by adding the sequel. The value line, the leading investment service, makes forecasts of future earnings and dividends by the procedure outlined above, and then derives a figure of price potentiality, or projected market value, by applying a valuation formula to each issue based largely on certain past relationships. In Table 11.2, we produced the projections for 1967 to 1969 that we made in June 1964 and compare them with the earnings and average market price actually realized in 1968, which approximate the 1967 to 1969 period. The combined forecast proved to be somewhat on the low side, but not seriously so. The corresponding projections made 6 years before had turned out to be over optimistic on earnings and dividends. This has been offset by use of a low multiplier, with the result that the price potentiality figure proved to be about the same as the actual average price for 1963. The reader will note that quite a number of the individual forecasts were wide of the mark. This is an instance in support of our general view that composite or group estimates are likely to be a good deal more dependable than those for individual companies. Ideally, perhaps, the security analyst should pick out the 3 or 4 companies whose future he thinks he knows the best and concentrate his own and his client's interests on what he forecasts for them. Unfortunately, it appears to be almost impossible to distinguish in advance between those individual forecasts which can be relied upon and those which are subject to a large chance of error. At bottom, this is the reason for the wide diversification practiced by investment funds, for it is undoubtedly better to concentrate on one stock that you know is going to prove highly profitable rather than dilute your results to a mediocre figure merely for diversification's sake. But this is not done because it cannot be done dependably. The prevalence of wide diversification is in itself a pragmatic repudiation of the fetish of selectivity to which Wall Street constantly pays lip service. So he's saying you shouldn't invest in one company because you have no idea what will happen to one company. But if you invest in a group of companies, the average return is pretty reliable, but not individual companies. So that's the table where they look at the companies and see what they projected they would do and what they actually did. And so that's the table if you want to screenshot it. Okay. So if you look at it, he has a bunch of companies in here. Allied Chemical, Aluminum Corporation of America, American Can, AT&T, American Tobacco, Anaconda, Bethlehem Steel, Chrysler, DuPont, Eastman Kodak, General Electric, General Foods, General Motors, Goodyear Tire, International Harvester, International Nickel, International Paper, Johns Manville, Owens, Illinois Glass, Procter & Gamble, Sears, Roebuck, Standard Oil of California, Standard Oil of New Jersey, Swift & Company, Texaco, Union Carbide, United Aircraft, U.S. Steel, Westinghouse Electric, Woolworth. Woolworth is out of business, isn't it? There's no Woolworth anymore, is there? Is there Woolworth? Okay, anyway. They forecast the amount of earnings that they would have. And so they have different forecasts. And then they have the price and the price forecast and the average price. So like the first one, Allied Chemical, they forecast $3.70 and the earnings were actually $1.46. So they're like half, almost half, which is much lower. The price in 1964 was 54.5. The forecast was that it would be at 67, but it was at 36.5. So obviously that one, if you had invested, you would have lost a lot of money. So that's one of the individual companies that did much worse than the forecast. Aluminum Corporation was forecast to go to 385 and it went to 475. The price was 71.5. It was forecast to go to 85, but it only went to 79. Okay, average. So American Can forecast for $3.50. Actual was $4.25. The price was $47. It was forecast to get to $57 and it got to $48 instead. AT&T forecast was $4 for earnings. The earnings were actually $3.75. The price forecast was 73.5. The price at the time was 73.5. The forecast said it would go to 68, but it went down to 53. Okay, American Tobacco, $3 earnings was the forecast. They actually earned $4.38. The price at the time of 1964 was 51.5. Price forecast was 33. They ended up being at 37. So the forecast was more right on that one. But you can see there's a large variability here, right? And it kind of goes on and on and on. And basically, at the bottom, the Dow Jones Industrial Average, which I guess is all those stocks, was 52 for earnings. The actual 52 was the forecast. The actual was 56. The price was 832. The price forecast was 820, but the average price was 918. So the Dow Jones actual was 57.84, 89 for earnings, and 56.26 from 1967 to 1968. And they adjusted for stock splits since 1964. The average was 1967 to 1969, and the difference was due to changed divisor. I don't know what they're talking about there. But anyway, they know what they're talking about. So basically, if you do individual companies, you could lose money, you could get money, but if you average out the whole group, you do get the average earnings of the whole group. Factors affecting the capitalization rate. Though average future earnings are supposed to be the chief determinant of value, the security analyst takes into account a number of other factors of a more or less definite nature. Most of these will enter into his capitalization rate, which can vary over a wide range, depending upon the quality of the stock issue. Thus, although two companies may have the same figure of expected earnings per share in 1973 to 1975, say $4, the analyst may value one as low as $40 and the other as high as $100. Let us deal briefly with some of the considerations that enter into these divergent multipliers. Number 1, general long-term prospects. No one really knows anything about what will happen in the distant future, but analysts and investors have strong views on the subject just the same. These views are reflected in the substantial differentials between the price divided by earnings ratios of individual companies and of industry groups. At this point, we added in our 1965 edition. For example, at the end of 1963, the chemical companies in the Dow Jones Industrial Average were selling at considerably higher multipliers than the oil companies, indicating stronger confidence in the prospects of the former rather than the latter. Such distinctions made by the market are often soundly based, but when dictated mainly by past performance, they are likely to be wrong as right. He has a footnote here. About choosing individual stocks versus a group. At least not by the great, he says it's not really useful, at least not by the great body of security analysts and investors. Exceptional analysts who can tell in advance what companies are likely to deserve intensive study and have the faculties and capability to make it may have continuous success with this work. For details of such an approach, see Philip Fisher, Common Stocks and Uncommon Profits. Harper and Row, 1960. Okay, we shall supply here in table 11.3, hold on, the 1963 year-end material on the chemical and oil company issues in the Dow Jones Industrial Average and carry their earnings to the end of 1970. It will be seen that the chemical companies, despite their high multipliers, made practically no gain in earnings in the period after 1963. The oil companies did much better than the chemicals and about in line with the growth implied in their 1963 multipliers. Thus, our chemical stock example proved to be one of the cases in which the market multipliers were proven wrong. Okay. Number 2, management. In Wall Street, a great deal is constantly said on this subject, but little that is really helpful. Under objective, quantitative, and reasonably reliable tests of managerial competence are devised and applied, this factor will continue to be looked at through a fog. It is fair to assume that an outstandingly successful company has unusually good management. This will have shown itself already in the past record. It will show up again in the estimates for the next 5 years, and once more in the previously discussed factor of long-term prospects. The tendency to count it still another time as a separate bullish consideration can easily lead to expensive overvaluations. The management factor is most useful, we think, in those cases in which a recent change has taken place that has not yet had time to show its significance in the actual figures. 2 spectacular occurrences of this kind were associated with the Chrysler Motor Corporation. The first took place as far back as 1921, when Walter Chrysler took command of the almost moribund Maxwell Motors, and the next few years made it a large and highly profitable enterprise, while numerous other automobile companies were forced out of business. Second happened as recently as 1962, when Chrysler had fallen far from its once highest estate, and the stock was selling at its lowest price in many years. The new interest associated with consolidation coal took over the reins. The earnings advanced from the 1961 figure of $1.24 per share to the equivalent of $17 per share in just 2 years, from 1961 to 1963. And the price rose from the low of 38.5 in 1962 to the equivalent of nearly 200 the very next year. And then here's a footnote. Part of the fireworks in the price of Chrysler was undoubtedly inspired by two 2-for-1 stock splits taking place in a single year, 1963, an unprecedented phenomenon for a major company. Number 3, financial strength and capital structure. Stock of a company with a lot of surplus cash and nothing ahead of the common is clearly a better purchase at the same price than another one with the same per share earnings but large bank loans and senior securities. Such factors are properly and carefully taken into account by security analysts. A modest amount of bonds or preferred stock, however, is not necessarily a disadvantage to the common, nor is the moderate use of seasonal bank credit. Incidentally, a top-heavy structure, too little common stock in relation to bonds and preferred, may, under favorable conditions, make for a huge speculative profit in the common. This is the factor known as leverage. Number 4, dividend record. One of the most persuasive tests of high quality is an uninterrupted record of dividend payments going back over many years. We think that a record of continuous dividend payments for the last 20 years or more is an important plus factor in the company's quality rating. Indeed, the defensive investor might be justified in limiting his purchases to those meeting this test. Current dividend rate. Number 5. This, our last additional factor, is the most difficult one to deal with in a satisfactory fashion. Fortunately, the majority of companies have come to follow what may be called a standard dividend policy. This has meant the distribution about 2/3 of their average earnings, except that in the recent period of high profits and inflationary demands for more capital, and the figure has tended to be lower. In 1969, it was 59.5% for the stocks in the Dow Jones average and 55% for all American corporations. Where the dividend bears a normal relationship to the earnings, the valuation may be made on either basis without substantially affecting the result. For example, a typical secondary company with expected average earnings of $3 and expected dividend of $2 may be valued at either 12 times its earnings or 18 times its dividend to yield a value of 36 in both cases. However, an increasing number of growth companies are departing from the one standard policy of paying out 60% or more of earnings and dividends on the grounds that the stockholders' interests will better be served by retaining nearly all the profits to finance expansion. The issue presents problems and requires careful distinctions. We have decided to defer our discussion of the vital question of proper dividend policy to a later section, Chapter 19, where we shall deal with it as a part of the general problem of management stockholder relations. Hi, Joanne. Are you back in California now? Are you still here in Hawaii? Hope you're doing well. Aloha. Okay, I'm going to keep reading. I'm reading chapter 11. Jamel was asking if you're still around. Oh, no. Are you here in California? Capitalization rates for growth stocks. Most back in LA. Ah, well, I'm glad you made it back. Hope you're having a good time there. Most of the writing of Security and Analysts on former appraisals relates to the valuation of growth stocks. Our study of the various methods has led us to suggest a foreshortened and quite simple formula for the valuation of growth stocks, which is intended to produce figures fairly close to those resulting from the more refined mathematical calculations. Our formula is value equals current normal earnings times 8.5 plus twice the expected annual growth. The growth figure should be expected over the next 7 to 10 years. Expected growth rate. Note that we do not suggest that this formula gives the true value of a growth stock, but only that it approximates the results of the most elaborate calculations in vogue. Okay. In table 11.4, we show how our formula works for various rates of assumed growth. It is easy to make the converse calculation and to determine what rate of growth is anticipated by the current market price, assuming our formula is valid. Yeah, where did you get your formula? Anyway, in our last edition, we made that calculation for the Dow Jones Industrial Average and for 6 important stock issues. These figures are reproduced in table 11.5. We commented at that time. The difference between the implicit 32.4% annual growth rate for Xerox and the extremely modest 2.8% for General Motors is indeed striking. It is explainable in part by the stock market's feeling that General Motors' 1963 earnings, the largest for any corporation in history, can be maintained with difficulty and exceeded only modestly at best. The price-earnings ratio of Xerox, on the other hand, is quite representative of speculative enthusiasm fastened upon a company of great achievement and perhaps still greater promise. The implicit or expected growth rate of 5.1% for the Dow Jones Industrial Average compares with an actual annual increase of 3.4% compounded between 1951 to 1953 and 1961 to 1963. This is the thing about math. They give you a formula and you're like, where did you get that formula? And he doesn't even say where. He just gives a formula. Anyway, whatever. Moving on. We should have added a caution somewhat as follows. The valuations of expected high-growth stocks are necessarily on the low side. If we were to assume these growth rates will actually be realized, in fact, according to the arithmetic, if a company could be assumed to grow at a rate of 8% or more indefinitely on the future, its value would be infinite, and no price would be too high to pay for the shares. What the valuer actually does in some cases is to introduce a margin of safety into his calculations, somewhat as an engineer does in his specifications for a structure. On this basis, the purchases would realize his assigned objective. In 1963, a future overall return of 7.5% per annum. Even if the growth rate actually realized proved substantially less than that projected in the formula. Of course, then, if that rate were actually realized, the investor would be sure to enjoy a handsome additional return. There is really no way of valuing a high-growth company with an expected rate, say, of about 8% annually, in which the analyst can make realistic assumptions of both the proper multiplier for the current earnings and the acceptable multiplier for the future earnings. As it happened, the actual growth for Xerox and IBM proved very close to the high rates implied derived from our formula. As just explained, this fine showing inevitably produced a large advance in prices at both issues. The growth of the Dow Jones Industrial Average itself was also about as projected by the 1963 closing market price, but the moderate rate of 5% did not involve the mathematical dilemma of Xerox and IBM. Turned out that the 23% price rise to the end of 1970 plus the 28% in aggregate dividend return received gave not far from the 7.5% annual overall gain posited in our formula. In the case of the other four companies, it may suffice to say that their growth did not equal the expectations implied in 1963 price, and that their quotations failed to rise as much as the Dow Jones Industrial Average. Warning: this material is supplied for illustrative purposes only. Because of the inescapable necessity in security analysis to project the future growth rate for most company studies, let the reader not be misled into thinking that such projections have any degree of reliability, or conversely, that future prices can be counted on to behave accordingly as the prophecies are realized, surpassed, or disappointed. So they're basically saying they made up a formula. It seems to have worked in general, but they make no promises that it'll ever work again or that it's a good formula. We should point out that any scientific or at least reasonably dependable stock evaluation based on anticipated future results must take future interest rates into account. A given schedule of expected earnings or dividends would have a smaller present value if we assume a higher than if we assume a lower interest structure. Such assumptions have always been difficult to make with any degree of confidence, and the recent violent swings in long-term interest rates render forecasts of this sort almost presumptuous. Hence, we have retained our old formula above simply because no new one would appear more plausible. Okay. Industry analysis. Because the general prospects of the enterprise carry major weight in the establishment of market prices, it is natural for the security analyst to devote a great deal of attention to the economic position of the industry and of the individual company in its industry. Studies of this kind can go into unlimited detail. They are sometimes productive of valuable insights into important factors that will be operative in the future and are insufficiently appreciated by the current market. Where a conclusion of that kind can be drawn with a fair degree of confidence, it affords a sound basis for investment decisions. Our own observation, however, leads us to minimize somewhat the practical value of most of the industry studies that are made available to investors. The material developed is ordinarily of a kind with which the public is already fairly familiar, and that has already exerted considerable influence on market quotations. Rarely does one find a brokerage house study that points out, with a convincing array of facts, that a popular industry is heading for a fall, or that an unpopular one is due to prosper. Wall Street's view of the longer future is notoriously fallible, and this necessarily applies to that important part of its investigations which is directed toward the forecasting of the course of profits in various industries. We must recognize, however, that the rapid and pervasive growth of technology in recent years is not without major effect on the attitude and the labors of the security analyst. More so than in the past, the progress or retrogression of the typical company in the coming decade may depend on its relation to new products and to new processes, which the analyst may have a chance to study and evaluate in advance. Thus, there is doubtless a promising area for effective work by the analyst based on field trips, interviews with research men, and on intensive technological investigation on his own. There are hazards connected with investment conclusions derived chiefly from such glimpses into the future and not supported by presently demonstrable value. Yet there are perhaps equal hazards in sticking closely to the limits of value set by sober calculations resting on actual results. The investor cannot have it both ways. He can be imaginative and play for the big profits that are the reward for vision, proved sound by the event, but then he must run a substantial risk of major or minor miscalculation, or he can be conservative. I'm doing well, Kizar. How are you? and refuse to pay more than a minor premium for possibilities as yet unproved. But in that case, he must be prepared for the latter contemplation of golden opportunities foregone. This book is funny. I'm sorry. It's funny because it's basically saying there's really no way for you to analyze stocks. But let's keep going, okay? The two-part appraisal process. Let us return for a moment to the idea of valuation or appraisal of a common stock, which we began to discuss above on page 152. A great deal of reflection on the subject has led us to conclude that this better be done quite differently than is now the established practice. We suggest that analysts work out first what we call the past performance value, which is based solely on the past record. This would indicate that what the stock would be worth absolutely or as a percentage of the Dow Jones Industrial Average or of the S&P Composite, if it is assumed that its relative past performance will continue unchanged in the future. This includes the assumption that its relative growth rate, as shown in the last 7 years, will also continue unchanged over the next 7 years. This process could be carried out mechanically by applying a formula that gives individual weights to past figures for profitability, stability, and growth, and also for current financial condition. The second part of the analysis should consider to what extent the value based solely on past performance should be modified because of new conditions expected in the future. Such a procedure would divide the work between senior and junior analysts as follows. The senior analyst would set up the formula to apply to all companies, generally for determining past performance value. The junior analyst would work up such factors for the designated companies pretty much in mechanical fashion. The senior analyst would then determine to what extent a company's performance, absolute or relative, is likely to differ from its past record and what change should be made in the value to reflect such anticipated changes. It would be best if the senior analyst report showed both the original valuation and the modified one with his reasons for the change. I'm almost done. Okay. Is a job of this kind worth doing? Our answer is in the affirmative, but our reasons may appear somewhat cynical to the reader. We doubt whether the valuation so reached will prove sufficiently dependable in the case of the typical industrial company, great or small. We shall illustrate the difficulties of this job in our discussion of Aluminum Company of America, Alcoa, ALCOA, in the next chapter. Nonetheless, it should be done for such common stocks. Why? First, many security analysts are bound to make current or projected valuations as part of their daily work. The method we propose should be an improvement on those generally followed today. Secondly, because it should give useful experience and insight to the analysts who practice this method. Thirdly, because work of this kind could produce an invaluable body of recorded experience, as has long been the case in medicine, that may lead to better methods of procedure and a useful knowledge of its possibilities and limitations. The public utility stocks might well prove an important area in which this approach will show real pragmatic value. Eventually, the intelligent analyst will confine himself to those groups which the future appears reasonably predictable, or where the margin of safety of past performance value over current price is so large that he can take his chances on future variations, as he does in selecting well-secured senior securities. Subsequent chapters, we shall supply concrete examples of the application of analytical techniques, but they will only be illustrations. If the reader finds the subject interesting, he should pursue it systematically and thoroughly before he considers himself qualified to pass a final buy or sell judgment of his own on a security issue. So that's the end of the chapter. It's kind of interesting. Basically, they have one formula, and they use it, and they say, hey, it projected it pretty much, and it's better than what current brokerage firms are using to predict things. So until something better comes along, use this formula. I guess in another book they justify where they came up with their formula, I guess. But their formula is value equals current normal earnings times, in parentheses, 8.5%, 8.5 plus twice the expected annual growth rate. Yeah, whatever. So anyway, that's what they do. And then they had that Annual earnings multipliers based on expected growth rate based on simplified formula. They have their table in 11.4 and 11.5. And expected growth rate multiplier of current earnings 8.5. And then they have all these, I don't know why they put that in. Oh, okay. If the expect growth rate is 2.5%, and growth in 10 years would be 28%, multiplier of current earnings 13.5. I really don't understand what they're. Let me look at 11.5. Implicit are expected growth rates December 1963 and December 1969. Oh, here we go. So we have some specific companies. AT&T. Their price to earnings ratio in 1963 was 23. Okay. Their projected growth rate based on the formula on page 158 is 7.3%. Okay, based on that price to earnings ratio. They earned per share in 1963, based on their earnings too, $3.03. In 1969, they earned $4. The actual annual growth was 4.75%. The price to earnings ratio in 1969 was 12.2, so the projected growth was 1.8%. So they projected it would grow 7.3%, but it actually grew 4.75%. AT&T. Okay, General Electric, they based on their formula, right? They projected it would grow 10.3%, and it actually grew 6%. General Motors, based on their formula in 1963, they projected it would grow 2.8%, and it actually grew 1.6%. IBM, they projected a growth of 15%. It grew 17.9%. International Harvester, they projected a growth rate of 2.4%, and it grew 1.1%. Xerox, they projected a 32.4% growth. It grew 21.2%. Dow Jones Industrial Average, they projected a 5.1% growth rate. It grew 2.8%. I don't know why they say their formula is good. It was not that accurate. Over-projected growth for most of them, except for one. Anyway, it's an interesting chapter. I don't know. Okay. Have a nice day, guys. See you tomorrow. Aloha.